Good afternoon and welcome to our initial OBBB webinar, the One Big Beautiful Bill, What You Need to Know. I'm Ryan Miller, a partner in KSM's Federal Tax Department, and I'll be leading us through the webinar today. But before we get started, let's cover a few housekeeping notes. And of course, we still have people joining us, but we're going to get going here. First, this webinar is being recorded, and the recording will be available on KSM's website for on-demand viewing soon after the webinar. We will also send you an email with the on-demand webinar link and with a copy of the slides. So the slides will be available for download via your email after the event. There's a lot of information to cover today in just 1 hour. Thus, as questions pop into your head, please write those down so you can follow up with your primary KSM contact or with one of the speakers after the webinar. We will not be able to engage in Q&A during the webinar, but the speaker contact information will be included at the end of the slide deck. As we move through the presentation today, you're going to hear from myself, Laura Galdoni, Tim Mosier, Stephen Schnelker, and Alex Zorinsky. The webinar does qualify for CPE. We use the Conference IO platform instead of polling questions to track attendance. Please log in now using the QR code shown on the screen or navigate to the Conference IO web address listed in the first bullet point and choose the current OBBB webinar session. You can access the Conference IO platform either on your phone or on your computer. So using your phone or your computer, log in now. Once you're in the session, you will first check in and then enter the code words that appear in the slides throughout the presentation. You must attend for at least 50 minutes and enter at least 3 out of 4 code words to receive full credit. Please remember to check out at the conclusion of the webinar. There will be another slide to remind you to check out, and certificates will be emailed from our learning management system in the next few weeks. And finally, before we move on to the presentation, we have our first code word, 966. If you are not logged into Conference IO yet, please write this down and input it as soon as you get logged into Conference IO. So 966 is the first code word. Jot that down if you're not in yet. Otherwise, go ahead and submit it. Going once, going twice, 966. And now, on to the presentations. We have a long list of topics to cover in a short amount of time. This is a significant piece of tax reform legislation with over 100 tax provisions. So, we cannot cover every single provision, but we will cover the most talked about tax provisions and the tax provisions that have the broadest impact to the most taxpayers. We'll also emphasize aspects that are more urgent than other aspects. So as we go through this, it's critical to make note of each provision's effective date. Does this impact 2025 or is it a 2026 issue? Some provisions don't really apply until 2027. And in the case of research expenses, you'll see there may be an opportunity to amend prior year tax returns. So there can be different levels of urgency across these different provisions and differences as far as immediate impact versus a future impact. I'm going to cover the first topic for us today. We have a quick mashup of 3 important deduction topics. And first, we have the SALT cap. This topic probably garnered the most attention in the media. This was a major point of negotiation between lawmakers who wanted to see the SALT cap increased versus those who didn't like the cost of it. So what is it? Well, the SALT cap refers to the threshold that limits an individual's itemized deduction for state and local taxes to $10,000. This also applies to trusts, but most of the discussion centers around the itemized deduction for individuals. There was a lot of discussion, a lot of back and forth, various proposals. So where did they land? Well, they landed on a temporary increase from a $10,000 cap to a $40,000 cap. This is effective for 2025 with small inflation adjustments through 2029, and then it reverts back to a $10,000 cap in 2030. So we have 5 years here with an increased SALT cap. However, the increased cap does start to phase out when modified AGI exceeds $500,000. and phases all the way back to $10,000 when income exceeds $600,000. So high income taxpayers, those with over $600,000 of income for the year, will not benefit from the increased SALT cap. And those between 500 and 600 will have a cap somewhere between 40 and 10. And I'll just make a real quick note that all these amounts, including the overall cap, are kind of halved if you're doing married filing separate returns. So one important takeaway is that high income taxpayers may not benefit from the much publicized SALT cap increase. Another takeaway is for those taxpayers that will benefit, if they've claimed standard deduction in recent years, this may result in going back to calculating and claiming itemized deductions. So maybe they need to tighten up their records with respect to charitable contributions, and at year end, maybe rethink the timing of Q4 state estimate payments, pay it in January versus December, that sort of thing. I do have a bullet point on here that says no new limitations on PTET deductions. I won't go into the details since we ended up with no change, but for anyone out there that was worried about the various proposals to limit or disallow PTET deductions, none of those proposals made it into the final legislation. So it's business as usual for PTET deductions and PTET regimes. Next is QBI. QBI is the extremely important 20% deduction regime for pass-through entity structures. The deduction was scheduled to expire after 2025, which would have had dramatic impact on the taxation of flow-through structures. But the 20% QBI deduction is permanently extended now, and it has been expanded a little bit by increasing the phase-in income limitations and providing a minimum $400 deduction for taxpayers that have at least $1,000 of active trade or business income. So these new QBI modifications, the new rules regarding income phase-in and the minimum deduction do not apply for 2025. Those modifications are for 2026 and beyond. 2025 is just kind of business as usual for QBI. And the final topic on this slide is excess business losses. For those of you that were worried about proposals that would make the carryover losses more difficult to utilize, none of those proposals made it into the final legislation either. So the EBL limitation is permanent now, and the limitation threshold is increased for inflation. But otherwise, the carryover losses continue to convert to NOLs in the carryover year, pretty much business as usual for excess business losses. Okay, and with that, we're going to try our first transition. I'm going to hand it over to Alex Zorinsky and Tim Mosier to cover the TCJA Big Three business deductions and some other important business deductions.
Thanks, Ryan. As Ryan said, my name is Alex Zorinsky. I'm going to start by talking about research expenses. So just as a brief reminder of how we got here, prior to TCJA, research expenses were deductible in the year they were incurred. When TCJA came out, there's a requirement that you capitalize and amortize research expenses. Pertinently, domestic research expenses were amortized over a 5-year period, and that began in the 2022 calendar year and is going to run through the 2024 calendar year. What this new bill does is they change how you treat those domestic research expenses beginning in calendar year 2025. And specifically what it does is the bill creates a new code section, code 174A, whereas previously research expenses were codified in section 174. Now 174A defines domestic research expenses and allows taxpayers to deduct those in their year they were incurred beginning in 2025. I should note that the old section 174A, section 174 still exists, but the domestic research piece has been removed from that. So now section 174 only addresses foreign research expenses, and those rules remain unchanged from TCJA. The foreign research expenses still must be capitalized and still must be amortized over a 15-year period. I should also note kind of very briefly is that presumably the IRS is going to issue new regulations or expand the existing 174 regulations that work to define what research expenses are for purposes of 174. I would assume that they're going to be the pretty similar definitions, so that's why it might be expanded, but obviously that hasn't been done yet. The other thing I wanted to briefly note is that 174A contains the language that specifically lists software development as a research expense. This isn't something surprising in that the old Section 174 also had that provision, but there's some inconsistencies on how the IRS treats that. So I'll talk about that a little bit more when we get into the accounting method piece of it. The last piece on this slide I wanted to talk about is 280C. So just for people who haven't heard of it before, 280C was kind of a provision that prior to TCJA, prior to capitalizing research expenses, if you took a research credit for research activities, you had to deduct your research expenses that were deducted by the amount of your research credit in the year that you were of the deduction. The other option was to reduce your credit amount by a set percentage. And the idea is that regardless if you reduce the expenses or reduce the amount of credit, you should come pretty close to net zero tax change. And that kind of changed under TCJA. So TCJA said that you only needed to reduce your research expenses to the extent that your credit exceeded your deductible QREs, so the research expenses that go towards the credit. And practically speaking, with the capitalization, that was all with the research credit, pretty much never exceeded the amortized QREs. So as a result, taxpayers typically got to take the full amount of the credit with no downside because they didn't have to reduce their amount of expenses or the amount of the credit. The downside obviously came in the fact that you had to take a 5-year spread on those deductions for domestic research expenses. This new bill changes that. So now it says that the deductible or capitalizable research expenses must be reduced by your research credit. So basically you have the option to either take a reduced research credit or to reduce the amount that you're either deducting or capitalizing in the way of research expenses by the amount of the credit. That is an annual election. So the next slide here is talking about the kind of the options you have. And I'll start off with saying that even though this bill allows you to deduct research expenses as they're incurred beginning in 2025, you still may elect to continue capitalizing the domestic research expenses if you choose. If you elect to continue capitalizing, you need to amortize them ratably over a period of at least 5 years. It could be longer, but it can't be less. And the amortization begins in the month in which the taxpayer first realizes benefits from such expenditure. That terminology there, first realizes benefits from such expenditure, isn't really well defined. So at this point, I'm not sure exactly what it means. We'll probably have to wait on guidance from the IRS. It's something to consider if you're thinking about capitalizing or continuing to capitalize. The other part of that is that if you make the election to capitalize, that's an irrevocable election. To change back to expensing research expenses as they're incurred, you need to file an accounting method change. Again, this is similar to the regulations where there is an existing method change for Section 174, which is now purely foreign, that probably will be updated to 174A. However, I should note that that accounting method change under 174, if they adapt it, specifically excludes an automatic change if it's for the development of software. So hopefully they come out with a new automatic change for 174A and software developments included in that for people in that situation. The other part I want to talk about here is how it applies to taxpayers going forward. So obviously all taxpayers who are capitalizing these 174 expenses will have capitalized amount that aren't fully amortized from 2022 through 2024. So what the bill provides is that you can elect to either deduct the remaining unamortized portion of those expenses from 22 to 24 in calendar year 2025, or you can elect to deduct those unamortized expenses over the next 2 years ratably, meaning equal amount in 2025 and calendar year 2026. That will be that election to deduct either in 2025 or in 2025 in 2026 will also be considered an automatic method change. So that's something else we're going to need guidance from the IRS on how to make that election. The next thing is for small business taxpayers. So there's a special carve out for small business taxpayers that essentially makes it so they can elect to treat as if TCJA never existed and go back and deduct all of their 174 expenses in the year they were incurred. Essentially, that means going back and amending 22 through 24 to deduct the full amount of 174 instead of the amortized portion. So I think the first thing to discuss here is what is the small business taxpayer? So that's defined under 448C, which is basically says that over the past 3 years, that taxpayer has to have under $31 million of average gross receipts. The $31 million amount is an inflation adjusted amount. So 31 million is the 2025 amount. And the second requirement is that a small business taxpayer cannot be a tax shelter. So if you're a small business taxpayer, then you can make this election to go back and amend these returns. Again, we don't have guidance on how that election is going to be made at this point. That's going to have to be issued by the IRS. We're hopeful that that guidance is going to be, because this is such a big issue, is going to be the top priority and will be forthcoming before the deadline in 2024, but we're not sure of that yet. As of right now, I think we're currently trying to hold on to all returns and seeing if there's a way that we can get that IRS guidance before the deadline comes. The next slide here is about 163J. So 163J is a interest expense deduction limitation for taxpayers who are subject to this provision. And basically that section said before the bill said that the taxpayers who are subject are limited to deducting interest expense to the sum of business income earned by the taxpayer, 30% of ATI, which is adjusted taxable income, and the floor plan financing interest of the taxpayer. The new bill changed that definition for those three amounts in a couple ways. First, they changed the definition of ATI by permanently restoring to the calculation of ATI an add back for depreciation, amortization, and depletion. So prior to this new bill, depreciation, amortization, and depletion would only be included in the ATI calculation prior to January 1st, 2022. This bill removes that January 1st, 2022 language, so it's applied to all years. Essentially, this reverts this calculation to an EBITDA-based approach. And kind of the takeaway is that this should increase your ATI and allow for more business expense deductions under 163J if you're subject. The second part of this is that they expanded that definition of floor plan financing interest. So that definition now includes trailers and campers, which are designed to provide temporary living quarters for recreational, camping, or seasonal use, and is designed to be towed or affixed to a motor vehicle. So essentially that means RVs and campers. If you have floor plan financing interest on those, you can include it in the 163J calculation. Those last two adjustments I talked about for the add back for depreciation and for the floor plan financing interest, those will both take place or take effect in calendar year 2025. This last part I'm going to talk about won't take place until 2026. So that is that the ATI calculation will exclude certain foreign income from that calculation. That specifically is Subpart F income, GILTI, Section 8, Section 78 gross ups, and those will be added to the adjustments in calculating ATI. Again, that last piece for that foreign income, that won't take place until 2026. I'm going to go ahead and pass it over to Tim to continue this on.
Thanks, Alex. So the first item I'm going to talk about is bonus depreciation. The bill reinstates 100% bonus depreciation for eligible property starting after January 19th of this year. The one thing I would caveat or point out here is that in instances where you have a binding contract to purchase the equipment, we have to look at the contract date, not necessarily, when it physically arrives. So I think the key point there is, bonus depreciation at 100% is back, but not necessarily every asset you place in service during 2025 is going to be eligible. In addition to the return of bonus depreciation, we also expanded Section 179. The total expensing amount increased from $1 million to $2.5 million. And then we also saw an increase in the phase out This is applicable for tax years beginning after 12/31/24. So for our calendar taxpayers, this would be 2025. The bill also has two important changes to how we account for long-term contracts. So generally for long-term contracts, the rule is that you have to use percentage of completion and you would recognize income throughout the life of the contract. Well, historically, there's been an exception to that for home construction contracts that you could use completed contract. And when we said home construction, we meant single-family homes, but also buildings that contained 4 or fewer dwelling units. So the new law, though, expands this to include residential contracts. And this is going to be applicable for contracts entered into for the first tax year beginning after July 4th. So for calendar year taxpayers, we're looking at contracts that are entered into in 2026. So this is going to benefit contractors working on apartments, condos, residential type projects such as those. The second change is related to the small business taxpayer exemption. So these are the same requirements that Alex mentioned a few minutes ago. We're looking for taxpayers that are not tax shelters and meet the 3-year average gross receipts. Those taxpayers have historically been able to use completed contract for any type of project so long as it was estimated to be completed within 2 years. The OBB gives us a little bit more flexibility in that it extends that period from 2 to 3 years. So allowing contractors to have more projects that would fall into this exemption. A lot of the things we're going to talk about today are really extensions of existing law. It's not necessarily new. It just, is not sunsetting or going away. Qualified production property is one of the things that is brand new. This is not something we've had before. And this relates to the 100% bonus depreciation for manufacturing facilities. It's important to note, unlike bonus depreciation that we just talked about, that's permanent. This is not permanent. We have 2 dates that we need to look at. So we're looking at assets placed in service between July 4th and before 2031. And then we need construction dates that start after January 19th, but before 2029. So similar to bonus depreciation, looking at the written binding contract, making sure our dates fall in those timeframes is crucial. So what is qualified production property? We'll walk through the requirements. So we're looking for non-residential real property that is used by the taxpayer. And we'll talk about what used by the taxpayer means more in a few slides. So used by the taxpayer as an integral part of qualified production activity. And we'll talk through qualified production activity on the next slide. It has to be placed in service in the United States. The original use must begin with the taxpayer. So if you buy a facility that's already being used for manufacturing, that would not qualify. You can buy a facility that's not being used for manufacturing and turn it into a manufacturing facility, and that could be okay. And then lastly, you just have to make an election for this to apply. So digging in a little bit further, what are qualified production activities? So there's really 2 things we're looking for. Number 1 is we're looking for manufacturing, production, or refining of a qualified product. The second is we need substantial transformation. So that's not a term that's really defined in the rules or in the law. We're going to probably need guidance from the IRS. I imagine for some companies it's going to be very straightforward, but for companies that are hovering around repackaging, light assembly, where does the line of substantial transformation fall? We'll have to get some more guidance for that. The bill also defines what is not qualified production property. So areas used for offices, administrative spaces, really things that aren't directly related to the production activity do not qualify. So it could be in that some instances we're doing some sort of breakout of a building. This part's manufacturing, this part's maybe, the headquarters or the office space. And then the other big item to point out here, and I think this one's really important, is that this does not apply to a lessor. So if you're leasing a building that's used as manufacturing space, you do not get the deduction. There is not any exception for self-rentals in the rule. So typically, in the past, we've advised companies to put manufacturing operations in one entity and have real estate in a second entity. It appears based on the way the law is written that won't work. So to the extent that you're going to go out and purchase manufacturing space, now we'll have to look at, where do we want to put that? Which legal entity? How are we going to take advantage or not take advantage of the deduction? So with that, I will pass it over to Stephen. As we transition here, we have our second code word. So this is code word number 2, and it is 221.
All right, thank you, Tim. Again, code word number 2221. All right, so now we're going to move on to a few other items. We're going to talk about some estate planning considerations, Trump accounts, and 529 plan changes. So to start, the new law extended and slightly increased the estate exemption. As you recall, under TCJA, it had doubled the prior exemption, but that increased amount was slated to sunset on January 1st of 2026. On January 1st of 2026, the estate exemption would have been cut in half to the pre-TCJA amount, which would have been approximately $7 million per individual. Under the new law, instead of sunsetting on January 1st, 2026, the exemption will slightly increase to $15 million per individual, and this is indexed for inflation. This provision does not contain a future sunset provision, so it would require Congress to pass another law to change it. Even though there's now some breathing room for the estate planning, it's not going to sunset on, we don't have to get everything done by January 1st, 2026. It is still important to move forward with planning that was already in the works, especially for those who are still subject to estate tax or may become subject to estate tax. It is equally important to start planning now for those who may become subject to estate tax at a later date. By acting sooner rather than later, the compounding effect of planning strategies can be more fully realized. So now I want to move on to these new Trump accounts. This is a new type of IRA designed for individuals under age 18. It is important to note that these accounts cannot be created and funded until July 4th of 2026. So this provides some time to analyze the various savings vehicles that are available and determine the best option for each person's situation. In order to be eligible for a new Trump account, the beneficiary must be a U.S. citizen who is under age 18, who also has a social security number. There are 3 ways that a Trump account can be funded. First, any person can contribute up to $5,000 to an account each year. This amount is indexed for inflation beginning after 2027. This amount is not deductible, but it will create basis in the IRA, just like a non-deductible traditional IRA contribution. Second, the federal government has created a pilot program where it will contribute $1,000 on behalf of children born after 2024 and before 2029, subject to certain limitations. And lastly, employers can contribute up to $2,500 for the benefit of their employee or their employee's dependents. This amount is excluded from the employee's income, and the employer receives a deduction. The IRS will need to issue more guidance on this option, but this could be a good employee benefit for employers to consider. Once the funds are in the account, there are investment restrictions until the beneficiary attains age 18. Before that time, the account can only be invested in a mutual fund or ETF that tracks the S&P 500 or a similarly broad index, which is invested primarily in U.S. companies. The IRS will need to issue more guidance on which indices qualify other than the S&P 500, which is specifically allowed. In addition, the fund's expense ratio must not exceed 10 basis points, and you cannot use a leveraged fund, so you can't use a 2x or 3x S&P fund. Prior to the year in which the beneficiary attains age 18, there are no distributions that are allowed from this account. Beginning in the year in which the beneficiary attains age 18, distributions can be made from the account. These distributions will be subject to the traditional IRA distribution rules. So included in income, subject to all the other constraints. So I have this slide here. It's a comparison of alternative accounts. As you can see, there's a plethora of accounts that you can choose from, and when deciding how you want to prepare for a beneficiary's future. And I just wanted to highlight that on this chart, that each option has its own set of tax, financial, and legal implications. So therefore, it's going to be really important that you consult with your team of advisors, including your tax professionals, financial advisors, and legal counsel, to determine the appropriate portfolio of accounts that will meet your specific goals. So there were some 529 plan changes that were also included with the OBBB. The new law expanded the use of 529 funds for elementary and secondary expenses. And so while the IRS will likely need to issue additional guidance on these expenses, I did want to note one item that we do know. You can now use your 529 plans for tuition for tutoring or educational classes outside the home. However, those funds cannot be paid to a person who is related to the student. It's also important to consider the tax implications. Not all states will consider these expanded categories as qualified expenses for state tax purposes. So this means that the states could seek to include that distribution in income for state tax purposes, and/or require the repayment of any tax benefits received for contributing funds to that 529 account. I also want to note that this provision applies to distributions that were made after July 4th of this year. So you could take advantage of these expanded class of expenses beginning immediately. The new law also increased the amount allowable for these elementary and secondary expenses up to $20,000 per year. But I'll note, however, that this increased amount is not effective until 2026. So for 2025, you're still limited to the $10,000 per year. And lastly, the law expanded the use for post-secondary expenses. And the key to remember here is that the term post-secondary credential is defined in the legislation. So it's going to be important to make sure that whatever credential you're seeking reimbursement for is listed in the statute, or if the IRS provides further guidance in the future, that it's included in that guidance. Like the expansion previously mentioned, this applies to distributions after July 4th of 2025, and it's still subject to the same state income tax considerations. So now I'll turn it back to Ryan to discuss the campaign proposal provisions.
Great, thanks a lot, Stephen. We're moving right along here, and we're moving on to campaign proposals. So this is the no tax on provisions that I'm sure we've all heard of. No tax on tips, no tax on overtime, no tax on Social Security benefits, and we've included here the new deduction for interest on car loans. So this slide shows Congress's effort to implement these ideas, and in a shocker to no one, they did it in a very complicated manner. First, the income side. So the tips, overtime, Social Security benefits. From an income perspective, the income is all picked up the same as it always has been. There's no change with respect to picking up the income. But now certain individuals will be allowed a deduction on their individual tax returns if they meet the various requirements. So these are all individual deductions. They're all subject to phase out over specific modified AGI thresholds. And they are also all temporary deductions. They are available for 2025. So they are retroactive to the beginning of this year, but they are only available through 2028. They are also available to taxpayers claiming the standard deductions. So these are not itemized deductions. So what are the amounts? Well, taxpayers can claim a deduction of up to $25,000 for cash tips. And the deduction for overtime compensation is up to $12,500 or $25,000 in the case of a joint return. So that's an interesting difference from the tip deduction. The tip deduction is a maximum of $25,000, whether single or joint. So there's a potential marriage penalty if you have two married taxpayers that both have tip income. And there's a potential marriage bonus for overtime if only one spouse has qualified overtime compensation. So kind of an interesting wrinkle in the maximum amount for tips versus the maximum amount for overtime. The senior deduction is up to $6,000 per spouse, so it can be a deduction of up to $12,000 on a joint return if both spouses qualify. And the deduction for personal interest on car loans is limited to a maximum deduction of up to $10,000. All four deductions are subject to phase out, so taxpayers with income in excess of the phase out limits will not be entitled to a deduction. Tips and overtime have the same phase out rules, with the deductions beginning to phase out at $150,000 or $300,000 on a joint return. And in the case of tips and overtime, this is a pretty long phase out. So the deduction is not fully phased out until $400,000 on a single return. So the range is $150,000 up to $400,000, and the deduction is not fully phased out until $550,000 on a joint return. And maybe I'll note here that married taxpayers must file jointly to take either the tip or overtime deduction. So the tips deduction and overtime deduction, those are not available on a married filing separate tax return. The senior deduction starts to phase out at $75,000 or $150,000 on a joint return. And this phase out range is $100,000. So the $75,000 phases completely out at $175,000, and the $150,000 phases completely out at $250,000. And the car loan interest deduction starts to phase out at $100,000 or $200,000 on a joint return. Here, the phase out is quicker, with full phase out of the $100,000 at $150,000. And full phase out on a joint return at $250,000. A little bit about who benefits. Eligible tip income must be from an occupation that is customarily and regularly associated with tips prior to 2025. The Treasury is instructed to publish a list of occupations that will qualify within 90 days. So that list is due from the government by October 2nd. Overtime is defined by rules in the Fair Labor Standards Act. We may need to consult labor attorneys or labor law experts if you have a question about whether your situation meets this requirement. Also, the overtime only applies to the extra 50% component on a time and a half situation. So, for example, if an employee is making $50 an hour and the employee works an overtime hour at $75 time and a half, only the $25 extra counts as qualified overtime compensation. The deduction is available, the senior deduction is available to individuals age 65 or older as of the end of the tax year. And the car loan, with respect to the car loan, this relates to new personal vehicles that were assembled within the United States, and it applies to new loans taken out after December 31st, 2024. And the final row on this chart relates to payer reporting. And with respects to tips and overtime, this is actually a very important concept for employers and other payers to think about immediately. The portion of an employee's income that qualifies for the tips deduction or the overtime deduction will have to be separately reported on the W-2s or 1099s in the case of payments to independent contractors. So it's important for employers to start thinking about or start talking to their payroll folks immediately about how this information is going to be tracked and captured so it can be properly reported. We're expecting guidance from the IRS about this, especially with respect to amounts that have been already been paid. Again, these provisions are retroactive to January 1st, and there may be opportunity to use reasonable methods to approximate for purposes of 2025. That's to be determined. And there's also potential for guidance regarding changes to withholding procedures in light of these deductions, but we have to wait and see. I don't think employees can choose to reduce withholding until there is guidance on the issue. So in any event, payroll departments and folks involved with payroll should be studying this very closely now and consulting with their payroll provider if you use a payroll provider, so that you're ready to do reporting at the end of the year. Okay, we're going to do code word number 3. Code word number 3 is 494. Code word number 3 is 494. Give you just one more second before we transition to Laura. 494, actually. Okay, with that, we're going to give it over to Laura to talk about a few key international provisions.
Thanks, Brian. So I'm going to give a high-level summary of the international tax provisions included in this bill. I want to be clear, this is a very high-level analysis, and I'm limiting how much background I give on some of these complex concepts. If you have concerns about the details behind any or all of the acronyms I'm about to use, please just reach out to your KSM contact and we can discuss it further. First, we can all finally say goodbye to the acronym GILTI. If you're asking yourself what even is GILTI, GILTI applies to controlled foreign corporations, or CFCs, control meaning majority owned by U.S. persons, and foreign corporation meaning an entity taxable as a foreign corporation for U.S. tax purposes. So this does not apply to any foreign flow-through type entities. So rather than GILTI, the new phrase is net CFC tested income. But you'll probably hear people continue to call this GILTI for a while, or 951 Cap A. Rather than GILTI, now on to the changes. The GILTI inclusion is currently calculated by determining the net CFC tested income reduced by a 10% return on the CFC's depreciable tangible assets, or QBI. This 10% reduction was beneficial primarily to U.S.-owned manufacturers. The Congress was concerned that this motivated U.S. companies to start building more manufacturing capabilities abroad and not buy American, so this benefit is removed starting in 2026. Next, the corresponding GILTI 250 deduction, which is available for C corporations and individuals in limited circumstances, and currently allows for a 50% deduction of your total GILTI inclusion plus your Section 78 gross up, has been revised to a 40% deduction starting in 2026. GILTI deemed paid taxes available for foreign tax credit were subject to an 80% limitation of the total CFC foreign taxes on tested income, and that limitation has increased now to 90%. It appears that by removing the QBI benefit, Congress decided to allow you to take more of a foreign tax credit on a larger GILTI inclusion. And finally, net foreign source income calculation for purposes of calculating the GILTI foreign tax credit no longer includes apportioning U.S. interest and R&D expenses included in taxable income. I do want to be clear, though, that this only seems to apply for the GILTI foreign tax credit calculation for now. So next, we'll move on to the carrot, to the GILTI stick, which is FDII, or as it will now be known, FDDEI. I'm going to keep calling it FDII for right now. High level, FDII applies to U.S. C corporations that export goods and services to non-U.S. customers. This was Congress's attempt in TCJA at policy to help drive down trade deficits by providing a federal benefit to exporters. FDII is only available to entities taxable as C corporations for federal tax purposes. Similar to with GILTI, the 10% haircut for fixed assets QBI is removed. For the GILTI side, this is detrimental to U.S. taxpayers, as removing the 10% haircut will cause a larger GILTI inclusion. On the FDII side, this is a benefit to exporters. The 10% haircut reduced your ultimate FDII deduction, so removing the haircut means a larger deduction. Also similar to GILTI, the FDII benefit is currently a deduction of 37.5%, and it will be reduced slightly to 33.34% in 2026. Another similarity to the GILTI adjustments, FDII deduction no longer includes calculating apportioning U.S. interest and R&D expense against the foreign eligible income. This change is specifically for purposes of calculating the 250 deduction only. And finally, FDII was very generous in the types of income that would qualify as foreign eligible income under TCJA. The OBBB has excluded 2 types of income that previously would have qualified. income from either the sale or disposition of an intangible property under 367D and any other property that's subject to depreciation, amortization, or depletion by the seller no longer qualifies for foreign eligible income. Now we have a few international provisions that have been needing fixes for years and were finally resolved in this bill. Both of these provisions apply also to CFCs only, not foreign branches or foreign partnerships. First is look-through treatment for CFCs. This has been a constant extender item that Congress has had to approve each year, and this bill made permanent. The impact here is that passive type income payments from one CFC to another related CFC when meeting certain requirements does not qualify for Subpart F. The second is the downward attribution drafting error from 2017. Even the enacting clause stated that Congress did not intend the outcome that ultimately resulted from the language included in TCJA, which attributes constructive ownership of foreign corporations to other U.S. persons in certain circumstances. The impact here was to make certain foreign corporations become CFCs, and then the U.S. shareholders were subject to GILTI, Subpart F income, and complex filing requirements. There is still a limited downward attribution concept, new Section 951 Cap B, which gets to the legislative intent initially proposed in TCJA. Two more changes to the CFC regime were also introduced in this bill. The first is that Subpart F and GILTI income used to be determined by the U.S. shareholder as of the last day of the foreign corporation's taxable year. It was an all or nothing inclusion based on the owner at a point in time for the year. Now U.S. shareholders must recognize Subpart F income and GILTI income pro rata for the period of time the U.S. shareholder owns stock in the CFC during the CFC's taxable year. This will be applicable when there's an ownership change in the CFC's U.S. shareholder. And then next, prior to this bill, a CFC was able to choose a year-end 1 month before its majority shareholder to allow for deferring deemed foreign income inclusions. This has been repealed for the CFC's first taxable year beginning after November 30th, 2025. In theory, if you've been utilizing this option, you'll most likely have to file two Forms 5471 to catch up the filings, one for a 12-month period and one for a 1-month period to get onto the U.S. shareholders, the majority U.S. shareholders year end. And then the last two provisions I'm going to cover do not apply to CFCs. The first is U.S. manufacturers that have a foreign branch with an office or fixed place of business in a foreign country, and the foreign branch sells U.S. manufactured products to non-U.S. customers, can now source up to 50% of the net income of the foreign branch to foreign source income for foreign tax credit purposes. This seems to be another provision to promote exporting goods to foreign countries and rewarding companies that do so. And then finally, the changes, two changes to the base erosion minimum tax, or BEAT, that's only applicable to C corporations. BEAT's a 10% minimum tax that's going to increase to 10.5% in 2026. BEAT is the U.S. answer to the push by the OECD to impose a global minimum tax on large companies. BEAT generally applies to taxpayers with average annual gross receipts for the last 3 tax year period in excess of $500 million, so not that many taxpayers. Also, beginning in 2026, those subject to BEAT when calculating their regular tax liability no longer have a reduction for R&D credits, which could theoretically help U.S. taxpayers that perform R&D domestically. I've got one last slide that I included with a couple two things that were not included in the bill that you can just look at whenever you have a chance. And I'm going to give it back to Ryan. Thanks.
All right, thank you, Laura. All right, we're moving along here. There are many, many more business-related provisions in the tax reform legislation, so we're going to cover a few more here. It's going to be a little rushed. It's possible we may run a little over, but I'll be sure to provide the fourth code word just before 2 p.m. in case your schedule requires you to drop at 2 o'clock. And don't forget, you'll receive a link to the recording so you can watch the end of it when you have time. But we're not going to be over by much. We're doing well here. The first additional provision we're going to talk about to kick off this section is the exclusion of gain from qualified small business stock. So at a high level, QSBS is stock that is originally issued by a domestic C corporation to the taxpayer. And there are many additional requirements that all must be met This is a pretty complicated and nuanced section that requires a lot of thought and careful planning, but the new law has expanded 3 of the requirements in a manner that makes QSBS more available and potentially more attractive. So first, the 5-year holding period requirement is expanded to a 3-tier partial exclusion regime by providing a 50% exclusion for a 3-year holding period, a 75% exclusion for a 4-year holding period, and the full 100% exclusion at 5 years or more. So 1202 benefits kick in at a 3-year holding period instead of the 5-year all or none previous rule. Second, the maximum amount of gain eligible for the exclusion is increased from 10 million to 15 million, and the 10 times basis rule still applies, so you get the greater of. And third, the gross asset limit at which a company can issue QSBS was increased from 50 million to 75 million. So there could be more companies eligible to issue QSBS if their gross assets are in that $50 to $75 million window. These expansions of the QSBS rules apply to stock issued after July 4th. So stock already issued remains subject to the old rules. And just a reminder, there are many additional requirements, and all other 1202 requirements still apply and must be met. But these 3 requirements were expanded by OBBB, and as always, 1202 is something to consider in structuring, but these expanded requirements could open it up to more taxpayers and be more beneficial. The Employee Retention Credit, ERC, we are almost done with this regime, I hope. The main point I want to make here is that refund claims filed for Q3 or Q4 of 2021 are disallowed if they were filed after January 31st of 2024. So if you have any claims pending that were filed after January 31st, 2024 with respect to these 2 quarters, those claims are going to be denied. The new law also extended some statute of limitations to 6 years and imposes additional penalties on certain ERC promoters. But we're going to move on to QOZs. The next handful of slides relate to qualified opportunity zones, or QOZ. QOZ allows taxpayers to defer capital gain income by investing in certain designated real estate investments. The existing QOZ program is coming to an end on December 31st, 2026. Those with existing QOZ investments may have capital gain to recognize in 2026. OBBB does not change that. That still applies. But the new law does provide for an indefinite QOZ program with respect to future investment opportunities. The new QOZ program will effectively start January 1st, 2027. So there is a little time yet before this expanded QOZ regime can be utilized. And that's about all we're going to say about QOZs today. There will be a lot more information coming out from our real estate experts in the coming months as we gear up for the 2027 launch. The next few slides will be helpful for you to review if you have a particular interest in the new QOZ program. Real quick, under the new QOZ regime, the QOZ designations will be a little harder to get with stricter income and poverty metrics, and there's a 10% basis step up at the 5th anniversary. The benefits are even more significant if the project is within a rural qualified opportunity fund. So this is a new designation that will be available to incentivize projects outside of urban areas. And the new QOZ regime will freeze the gain exclusions after 30 years. So again, more to come on QOZs in the coming months. This slide is just further proof of how many provisions are in the bill. These are all additional provisions that we're not going to cover in any detail, but I do want to make a couple quick notes. First, I'll just note that C corporations are going to have a 1% of taxable income haircut to their charitable contribution deductions, and the overall 10% limitation still applies. There was a small expansion of the exclusion for employer payments of student loans. The next 5 bullet points after that are credit regimes that were all enhanced, so all become more favorable if you deal with any of these credits or have looked at them in the past, you'll want to revisit the new rules. And then I thought I would note real quick, the 1099 reporting threshold is going to be increased from the long-standing $600 to $2,000 and adjusted for inflation going forward. And with respect to 1099K, the reporting threshold is being restored retroactively. So I noted 2025 here on the slide. All the provisions above that are 2026 provisions, including the 1099 movement to 2000. But the 1099K is a retroactive provisions. And the last bullet point here is a new benefit if qualified farmland property is sold to a qualified farmer. There may be an opportunity to spread out the tax payments over 4 years in that sort of situation. So we're going to move on to the rest of the TCJA extensions that were very much publicized. But first, I'm going to give you a little bit of whiplash because I do want to give you the fourth code before 2 o'clock. We're going to come back. Believe it or not, we're going to go through this pretty quick. But code word number 4 is 585. So go ahead and record code word number 4. And if your schedule requires you to drop off at 2 o'clock, don't forget you're going to get the recording. But code word number 4 is 585. Okay, we're going to spend a few minutes going through this. So the rest of these extension items are primarily individual provisions. Some of these are pretty straightforward. Just a continuation of the law we have gotten used to since TCJA was enacted back in 2017, 2018. This slide shows 3 TCJA era provisions that were all made permanent. The lower individual tax rates with a maximum individual rate of 37%, the increased standard deduction amounts, and permanent termination of personal exemptions other than the new senior deduction we discussed earlier. The child tax credit was permanently increased to $2,200 and indexed for inflation. And I'll note on this slide that the mortgage interest deduction is permanently limited to interest on $750,000 of acquisition indebtedness. Some of you may remember that this used to be $1 million before TCJA. I'll note on this slide the permanent limitation on personal casualty loss deductions with an extension of the time frame for qualified disaster treatment, so that can be beneficial in certain circumstances. Again, you can read through the slides. A lot of this is pretty straightforward. But the P's limitation is interesting. The new rule starting in 2026 is going to be an overall haircut on total itemized deductions with when there's income in the 37% tax bracket. So high income taxpayers will see a reduction to their total itemized deduction, and the permanent increase to the AMT exemption and AMT phase out is important, especially for taxpayers taking advantage of the increased SALT cap. AMT limits the value of an increased SALT deduction, but this provision will help keep folks out of AMT. And I do want to take a second on this slide. There could be some interesting fact patterns presenting themselves with respect to individual charitable deductions. First, the above the line charitable deduction for non-itemizers comes back in 2026 and at higher amounts. But notice this second row here. There will be a new haircut to the itemized deduction for charitable contributions starting in 2026. The individual charitable deduction for itemizers will be reduced by 0.5% of AGI starting in 26. So what is the potential interesting fact pattern? Well, 2026 will not only see the 0.5% haircut to the charitable deduction, but there will also be the new P's limitation that we just talked about, reducing total itemized deductions. So when we get to year-end planning, taxpayers that are contemplating a significant charitable contribution in early 2026, could they benefit by accelerating it into 2025, assuming the circumstances allow such an acceleration? Maybe not, but it's definitely a discussion point and something that we're going to want to consider. And of course, you can use a DAF to bunch charitable deductions into 2025 if taxpayer facts indicate there's value to that. So interesting changes on the charitable contributions. Not going to say much here. The wagering losses on this slide, for those of you with gambling winnings and gambling losses, the deduction for gambling losses are limited. There's already talk in Congress about pulling this one back. The code word, I already gave this out, so if you've already recorded it, it's not new. It's 585, code word number 4, 585. Only need to record it once. And energy credits. We're not going to cover energy credits today, but you can see the slide deck, which you're going to receive in your email. Contains several slides that list out the various credits impacted by OBBB. And you can see a lot of them are terminating much sooner than previously scheduled. So you can notice the termination dates and the change in those termination dates. So if you have projects that were planning to take advantage of certain energy credits, especially IRA era credits, you'll need to revisit the credits to determine if the project will still benefit or not. This goes for anyone that was planning to utilize any sort of green energy credit. You'll need to see if your credit is on this list and what the new rules are with respect to it. Again, you can see lots of energy credits impacted by this new tax law. And with that, we're going to wrap it up today. The slide deck will have speaker contact information. You will receive the slide deck for download after the presentation. Don't forget to check out of Conference.io. Go ahead and check out now. And that's it. Thank you so much for attending. We really appreciate it.